Welcome back to educator.com. Today we're going to go over the gross domestic product. As a note, this is actually going to be the first true section of macroeconomics. The reason why I say true version is that the previous lectures, they were applicable for both micro and macro. So GDP is actually the beginning unit of the macroeconomics part of the AP macro curriculum. So let's go ahead and get started here. So in today's lesson overview, we're going to deal with how economists use aggregate measures to track economic performance. We're going to explore the circular flow diagram in tracking the macroeconomy. We're going to look at both the simplified model and a little bit more of an expanded model to show you how the macroeconomy works. We're going to define GDP, and we're going to find the three ways of calculating it. I'm going to briefly touch upon the differentiate between the GDP and the GNP. We're going to distinguish between nominal and real GDP data. And I'm going to make a point. We're going to go over an example to figure out how do you actually calculate nominal and how do you calculate real GDP. And finally, we're going to examine the importance of GDP per capita. So national accounts. What the heck is national accounts? I think maybe if you're going through the AP outline given, there's a whole section on national accounts, and sometimes you might not come across that term, so it's a little intimidating, that particular term. But again, don't be confused because it's a terminology that's not necessarily used in your class here. I actually don't even mention national accounts too much with my students, but basically it's a very simple definition. So national income and product accounts, or you can call it national accounts, it just simply refers to how the Department of Commerce tracks spending in the aggregate. So it's just a fancy way of saying, how do we calculate the things that everyone, whether it's a business, consumers or exports or imports, how do we calculate this in totality? So that's what national income accounts is. And so there's various measures where the government, through the Department of Commerce, can track this data here. Now, the most famous equation that you're going to use, or the most important one actually for this AP course, is the macroeconomic equation, also the Keynesian equation. You're going to see this AP macroeconomics course. There's a lot of John Maynard Keynes in this course here. Macroeconomic equation is going to equal Y equals C plus I plus G plus NX. I think it's worth rewriting here. So Y, which is the GDP, is a mixture of consumer expenditures, investment spending, government spending, and then the exports minus the imports, okay, which is basically saying NX. So again, this is the big macroeconomic equation that, when you get started, make sure, if you're just starting this course and trying to learn, what is macroeconomics all about, this is a good starting point. This is a good way to figure out how to break things down from a macroeconomic perspective. So what do each of all these symbols mean here? So Y, which is another way of saying GDP, is basically the aggregate demand. So imagine all the things in the economy that people want. And GDP, aggregate demand, that's a measure of all things that people want in the economy here. And it's broken down into its four different components. The first component is consumer expenditures or spending. So all the things that people are purchasing, so consumer expenditures, that makes up a huge percentage, at least for the American economy. We have a pretty big appetite for consumer expenditures. And a lot of people would say that's what drives our economy, for better or for worse, right? You have investment spending by businesses here. So another way the economy can grow, again, the most recent economic reports shows that there's a lot of investment spending. That could be the case where the economy grows there. And actually, one of the things that really hurts the economy when businesses don't spend, and so there's no investment in the GDP. And so the economy or GDP numbers can go down. And another way the economy can grow, and this is what Keynes really emphasized, if businesses aren't doing it, if consumers aren't spending, then this is where the government steps in, particularly during recessionary times. And again, the graphs that we're going to come across can be fairly complicated, but John Maynard Keynes postulated that, you know what, it's a job of businesses to enact fiscal or monetary policy to jump in when businesses just simply aren't getting it done. One of the famous quotes that John Maynard Keynes is known for is, in the long run, we're all dead. So he might agree that everything might go back to its equilibrium, but macroeconomic theory, as espoused by John Maynard Keynes, we're going to go over a lot of it, whether you agree with government intervention or not. I mean, you could be a classical economist, you could be someone who favors F.A. Hayek, the idea of government not intervening. Well, the reality is that if you want to pass the AP macro exam, you can't just do nothing. You can't just decide not to do anything. You really have to figure out, what is John Maynard Keynes saying? What is fiscal policy? So this y equals c plus I plus g plus nx, this g part of it is actually going to be fairly essential, because it's the idea, what is the proper role of government in intervening in GDP? And then finally, you have net exports. So what is net exports? Well, it's exactly that. You add all the exports, all the fast food chains, all the entertainment that we export, we add that to our GDP, and you basically take out a lot of the manufactured goods. Again, I'm a big fan of bobbleheads. Pretty much every bobblehead that I'm aware of, that I collect or sell on eBay, they're all these things that you find on eBay. They're actually made in China. The shirts that we wear, the shoes that we wear, very rarely are you going to see them actually manufactured in the United States. So you actually would take this out of our economy, and we as the United States, the United States actually imports a lot more than it exports. So it actually is a negative impact. Conversely, China is going to have more exports than imports, so you're going to have a positive impact. It's a very export-driven economy. A lot of the East Asian tigers, Taiwan, Korea, a lot of these countries that grew economically, a lot of it was export-driven growth. So international trade is very essential to creating economic growth, right? So that's basically what's going on here. Now, one thing I do want to mention here is sometimes you're going to get GNP versus GDP. So what is the difference here? So whereas GDP, the place of origin matters, so the definition of GDP is going to be the value of all goods and services produced within a country's borders. GNP is going to be very similar, but what it's going to do, it's the value of all goods and services, and what you do is you also add the nationality. So if you have a Korean national living in the United States, you would take that out of GNP, and if you have an American living in Korea, you would add that to U.S. GNP. So GNP and GDP, they're going to be very similar because they're tracking really very similar data. But the switch was made really to go with GDP, at least as far as the AP curriculum is concerned, simply because that calculation is what's more out there in the media. GDP numbers are what's reported, not really the GNP number. So I'm not going to go over a whole overview on GNP versus GDP. Just suffice it to say that the GDP is the figure that is going to be the most popular one, and for all intents and purposes on this exam, be familiar with GDP and how that's actually used here. But again, it doesn't hurt to know that GNP exists and what actually it encompasses. So the circular flow of the economy. Let's go ahead and review what is the circular flow of the economy. One of the things I do in my macro classes, both in my general classes and also my AP Econ class, is I have students play the role of a household and firms, and what they do is I give the household side, I give them resource cards or factors of productions. The business sides, I give them money. And basically, I basically have them trade. So the households, they're going to want to sell their resource cards. I give them 15 total cards, land, labor, and capital. And businesses, they basically have money. And so they're the buyers in this market, in the factor market. And so they basically interact. I don't tell them what price that they want to sell their resource cards, but they individually transact. And then once that happens, the businesses now have their factors of production, or the land, labor, and capital, and the households, they have the money, right? So we just engage in the factor market, and now you engage in the product market. So now the businesses are the ones that take the land, labor, and capital. They exchange it. I call it an econo, or final good and service. They exchange one land, one labor, one capital for an econo, and then they turn around and sell that econo to the household. So what they end up having is a final good and service. And so this is called the product market. So what you have is now the households, they're the consumers, and the businesses, they're the sellers. And so this is what's going on. And if you magnify it out, you have a lot more complicated scenario. But that's basically what a circular flow is. And I'll give you a very a simplistic representation of how a circular flow actually looks. And then I'll give you a little bit more complicated outlook here. So as I said before, circular flow really is a simplistic representation of a complex macroeconomy. So GDP, all these things, you don't really have to call it that way. You can just say how income and expenditures, they will tend to equal each other here. So what are the different aspects of a circular flow? So you have the household, you have the firms, you have the product market, and you have the factor market. So what's going on in each of these scenarios here? So households, they're just either a person or a group of people who own the factors of productions. And what are the factors of production? You have land, you have labor, and you have capital. So households, they own these factors of production, and they're the ones responsible for selling it to the firms or businesses. So the businesses that produce goods and services, they're the resource processors, whereas the households, they own the factors of production. The businesses, they get it and they transform them into final goods and services or econos or what have you, right? And this exchange actually takes place in the product market. So the place in which goods and services are bought and sold, whatever it may be, this is the product market. Now, where the household sells their land, labor, and capital, this is going to be referred to as the market in which land, labor, and capital are bought and sold, and that's the factor market. So yeah, I'm not the best artist here, and this is an AP art, this is AP macroeconomics. So again, if you're taking this class and you enjoy this kind of stuff, it's definitely a plus if you can draw, but definitely not required. And one of the things for an FRQ question, it's not going to be something where they ask you to draw the circular flow diagram. I mean, I guess it's possible. It's never been done that I'm aware of out of the list of sample FRQ questions. But for the multiple choice test, in the context of multiple choice, you might want to know specifically, what are the factors of production, what's a product market, factor market, these basic things, basic players in a macroeconomy. So I'll go ahead and sketch out, again, using the limited artistic ability that I have, of what a circular flow diagram actually looks like. So you have the household, so go ahead and draw a house. Again, a pretty pathetic looking house here, but a house nonetheless here. And you have a nice green tree here. Okay. So you have a household there. And let's go ahead and draw a factory right here. So this is a firm. So you have a firm and a household here. Now, to give you an idea, households, what they own is they own land, labor, and capital. So they are the resource owners. And the firm, on the other hand, they're the resource processors. So they're the ones that take the land, labor, and capital, and they process it into the final good and service. Now, quite obviously, when you have tons of different things in a very complex economy, it takes entrepreneurs to take all these different, different factors of production and produce something different here. But they're the ones that basically are the ones that drive an economy, the entrepreneurs of the economy. And so they can make money through rent, wages, interest, or profit here. So what goes on here in the factor market here? In the factor market, in this circular flow diagram here, you have a flow of goods here. So households will go, I'll just label this 1 right here and say households are going to supply land, labor, and capital. So again, they're the owners of land, labor, and capital, so they're going to supply it. But again, we understand that you're not going to work for free. You're not going to give away land or resources. You're going to sell it. So they're the sellers in the factor market. Households are the sellers, and what do? They get income as a result. So I'm going to draw an arrow here, number 2 here. So businesses or business firms, they provide households. And there's 2 ways of saying this, with either, factor or income payments. So the households are the sellers in the factor markets, and the businesses are they're the buyers or the purchasers in the factor market. So there's an exchange that's made. And again, you can actually calculate the factor income, and you can actually put a value. This is one way of calculating GDP, which we'll go over as well. Another way here, another thing that happens here is not only the factor market, you have the product market. So I guess the third step, again, it doesn't really matter which order because this is all happening simultaneously. What you end up having here is that on the inner circle here, the physical flow of the economy here. So this is the third aspect here. So now the firms are providing households. The firms are providing households with final goods and services. So firms make final goods and services. Now again, just like individuals and households, I know I wouldn't do things unless I got paid for it. Same thing, businesses are not going to produce a product unless they get properly compensated for it. So a natural arrow here would be the households providing land, labor, and or households making sales payments. I'm sorry. Households provides sales payments to firm for goods and services. Let's just put G and S. Okay, so that's basically what's going on. So basically, if you look at the outer arrows here, so which I put in green for purpose here, this is called the monetary flow. So you can actually track the money amounts that all the goods and services that are produced. And again, theoretically, what someone's income is also someone's expenditure. Now again, you can kind of find a flaw in that, but this is basically the circular flow model. So this is all the stuff that we buy. This is the GDP here, using the expenditure approach here. And then this is all the stuff, all the income that we make. So someone's income is also someone's, is someone's expenses. So this is the monetary flow. But what really drives the economy is the physical flow. So this is what you have here of the physical flow. This is going counterclockwise there. So the monetary flow in this particular case, depending on how you draw it up here, but the monetary flow is going clockwise, and the physical flow, so the actual stuff that's going on in the economy, this is the counterclockwise way. So firms are the ones that are buying stuff. or firms are the one that are providing stuff to households, and households are providing their land, labor, and capital to firms. So this is what's going on. Now, if you had to ask which is the most important part of an economy, then clearly it's the physical flow. Not that the money isn't important, but one of the things I try to highlight and make sure kids are understanding of when you're dealing with the economy, when we do the simulation in class, I give one side of the classroom, again, 15 resource cards, and one side $1,000. Sometimes I throw more money in there. But basically, I ask them, how do you grow an economy? What's one way we can actually grow the economy? And I think most kids kind of intuitively understand, if I just throw money into the economy, then what ends up happening is just prices go up. You have inflation. Now, instead of $200 for resource cards, the price actually goes up to like $400 or $500, right? The way you actually grow an economy is you add more resources, you add more human capital, you add more land, you add more labor. And one of the things I do to try to show this, and again, students love this because they like the idea of interacting with others. So this is a good simulation to run in class. So I highly recommend it. Any teacher, I don't care what level, when you're teaching macroeconomics and a circular flow, it's definitely worthwhile to do a circular flow diagram because kids are naturally greedy. They want more stuff. They want more money. You give them incentives, and this is a good thing to do in the classroom. And basically, the idea is that if you want to grow the economy, it's the resources that actually increase a nation's wealth. So one of the things I do is, I yell out during the simulation, does anyone want to buy more land? Anyone want to go to college? And they pay me $100, so they invest, and I give them 4, 5, 6 resource cards. And at the end of the simulation, they end up having more econos, or they make more money. And so they realize it's really not the money. The money is the means by which we exchange goods and services. But the true nature of the economy is a nation's land, labor, and most importantly, the human capital. And it takes the entrepreneurs of each society to basically get more value, get people spending their money, and create value in the economy. So that's basically what's going on. So here's an expanded circular flow diagram. So what I just showed you was a very simplistic view here. To give you an example of how an expanded diagram looks, let's just kind of look at the main features of an expanded circular flow diagram. So same thing here, you have households and you have firms here. And it's drawn a little bit differently, but it's the same concept here. So you still have your factor markets right here, and you have the market for goods and services, which is a fancy way of saying product markets here. So households they'll make wages, profit, interest, and rent here. So firms are going to pay them for their labor here. So this is where the money is flowing to households here. Now households, on the other hand, they're going to take their hard-earned money and they're going to spend it on consumer expenditures here. Consumer expenditures. Now, the gross domestic product is, and I mentioned this before, the amount of money that has gone to spending all the stuff. That's basically the gross domestic product here. But again, this is a little bit more complicated. And again, I'm not gonna. This lecture isn't meant to go over all the complicated aspects of the circular flow, but just to give you an idea that there are different parts of the economy that should really be considered. Well, first of all, there's a government. Okay, so and again, that's the idea that there's all the money that you make. Well, guess what? Some of it goes to taxes. Sometimes the government spends money it doesn't have, so it borrows. And this is where a whole macroeconomy can get fairly complicated. But very simply, this here, the taxes are taken out here. So all the money that's made is taxes. So basically, if you take your income, your gross income, minus taxes, then you have your disposable income. And that's going to be a concept, the idea of post-tax money, that's going to come into play here. But taxes are taken out, and also as taxes are taken out, you can actually say, well, some of that tax money is basically redistributed back to the households through government transfers. And again, the two of the more popular government transfers would be unemployment, because you're taxing a group of households that have jobs, and when times get rough, you're giving that money back to a different sector of the economy that is out of luck, doesn't have a job. Probably the more famous or the more familiar of the two is Social Security. Social Security, you take away, right now the Social Security tax is 6.2%. So any W-2 employee pays 6.2%. Employers that hire employees, they also pay 6.2%. So 12.4% of wages is used to give to the government, which it redistributes in the form of government transfers. Now, what happens if the government takes in $1 billion in taxes? U.S. takes in a lot more than that, but they give $2 billion in transfers. Well, there's a mismatch right here. And this is where government borrowing takes place. Now, where does the government borrow money? They look through the financial markets, right? And so they will not only redistribute right back to the households, but the government will actually also partake in directly purchasing goods and services. And so there's a market that the government actually purchases for goods and services as well. So they'll borrow from the financial markets. Now that begs the question: they borrow it. How does it take place? How does the government borrow? And when they purchase, where does everything go here? Well, let's take a look from this side here: markets for goods and services. So not only is there household consumer spending, well, firms are going to invest some of their money. They're going to invest some of the money, and that accounts for part of the gross domestic product as well. And so as well, not all consumer expenditures are going to be counted in GDP. So exports, so that when the rest of the world chimes in and they participate in this market, this amount is actually when the rest of the world, when you have the exports, that's included as part of GDP, but at the same time, the imports are excluded from the GDP. So when you're dealing with imports and exports, there's got to be a balance. So when the U.S. is exporting, well, there's going to also be foreign borrowing and sales of stock to kind of counter the amount of exports. Similarly, there's also going to be foreign lending and purchases of stocks if there's imports. So if we import a bunch of stuff from China, if the United States takes in a lot of imports from China, well, there's going to be foreign lending and purchases of stock because how did all these goods come into the United States? There's got to be kind of exchange that's being made here, and so there's a lot of different things that are going on. For example, households, they can spend their money. Now, a different way of growing the economy, maybe more of a supply side way, the idea that growth is not really driven by consumption. Some economists might say it's private savings. So when households save money, what they're doing is they're adding to the flow of money that is added to spent more for investment. So when you don't spend money, then theoretically it goes towards private savings, which banks will use to invest, and they're going to lend out more to firms. So some people, most notably F.A. Hayek, would argue that the economy is better off when we don't spend, but rather we save our money, which our savings are going to be used by businesses in the form of more borrowing and more capital formation available. So, this is a very complicated. You might have in some econ textbooks, you might have some examples with certain numbers, but the general idea here isn't really that you have to know that. If there's 180 million going this way and 40 million going this way, I think that really overcomplicates what's required on the AP macro. It's just the idea of when you're dealing with private savings, the supply of loanable funds, how is that affected? When you're dealing with investment spending versus imports, if that's impacted, what happens to the GDP? But if you notice, you can kind of map these things out. But the basic macro equation is Y, which is the aggregate demand, GDP, is C plus I plus G plus NX. So it really boils down to this macroeconomic equation. The GDP equals the consumption plus the business expenditures plus government spending and the net export. So again, this is an introduction to GDP. So again, it's helpful to know the basic level, the simplified circular flow diagram, but also the expanded circular flow diagram, and to see how everything flows in terms of if this happens, then what is the what is the reason why there are exports and why there are imports. So it is helpful to review and examine. So GDP, let's explain GDP a little bit in more detail here. So GDP, so the definition of GDP is the total value of all final goods and services produced in an economy in a given year. And so a couple of key words here that you want to notice here. This is the total value of all final goods and services. So that excludes intermediate goods and services. And it produced in an economy. So this is within the United States from the U.S. GDP perspective, given in 1 year. Okay, so I haven't really gone over real versus nominal, but just suffice it to say that GDP is kind of a lot of it is an estimate, but all the stuff that's going on, you put a money to it. Now, if you want to actually put numbers to it here, so let's go back to 2009. In 2009, U.S. GDP was about $14.3 trillion. And again, when that number is reported, keep in mind it's the real GDP, so the nominal is actually probably a little bit higher, but the real GDP is around $14.3 trillion. Now, what does that actually mean? That means $14.3 trillion worth of goods and services were purchased in the economy. And conversely, Americans made $14.3 trillion. Now, when you actually do the counting, it might be 14.2 trillion and 14.4 trillion or 14.8 trillion. So you give or take a couple $100 billion, depending on which way you actually calculate GDP. But that's a tremendous amount. And a lot of people say that this is the best measure to measure economic growth. And again, there's some validity to that. Some people will use, well, what about GDP per capita? What about GNP? What about some other numbers? But GDP is kind of it's the raw data, how much stuff is produced. There's an alternate measure called gross national happiness. The King of Bhutan actually comes out with this data which measures people's happiness, a little bit more subjective. I mean, one thing that I find kind of interesting, they survey the citizens and they ask, on a scale of 1 to 10, how happy are you? And they use that measure to figure out the gross national happiness. Now, if you take a look at that, the U.S. isn't the number one country in terms of happiness. We might be closer to like 13, 14, or 15, right? But it's a little bit subjective. With GDP, the economy might be producing cigarettes and alcohol and bad stuff, but it gives you an idea of raw economic data. So GDP, however flawed it is, it really is a good measuring stick of how much stuff a country produces. Be it good stuff or some bad stuff as well. 71% of the American economy is through consumer expenditures. 11% is business investment. Again, this is in 2009 specifically. And government spending, which probably has increased over time, represents 21%. Now, again, if you add these together, this is actually 103%, meaning that the U.S., it's negative 3%. You take out 3% because we import more than we export here. So the first method of calculating is by surveying firms and adding up the total value of their production of final goods and services. So this way here is you survey firms and then basically you discount the intermediate goods. So for example, you go to Ford. You go to Ford here, intermediate goods are not counted. So when Ford produces the entire car, well, guess what? You don't include the cost it required in order to produce the windshield, because you'd be double counting, because the windshield maker, they're going to count, they would count that, but if you include that and also the actual final goods and services, then you'd have double counting here. So the first method is, again, by adding the total value of the production of the final goods and services. The second method is adding up all the aggregate spending on domestically produced final goods and services. That one's easy. So you add up the purchases here, and here. Whereas the previous one, you figure out the value added here. And then the third way, again, this is probably not the most used way, but this is the way that maybe is a little bit more accurate. It takes a little bit more time. So once in a while, when the GDP numbers are reported, it's usually reconciled later using this third method here, which is adds up all the factor incomes. So wages, interest, rent, profit made from sales. So the expenditure approach, you basically add up all the Best Buy purchases, all the McDonald's purchases, you add that all up. And then the factor income approach would be, how much do all the Best Buy employees make? How much do McDonald's employees make? How much does all the income that is earned by Americans, what does that produce? And basically what we said here is that Americans earned $14.3 trillion, at least in 2009. So those are two different ways that they try to reconcile together in order to get a fuller look at what the GDP is. We're going to go ahead and take a look at real versus nominal GDP. Up to this point, we've only looked at GDP, regardless of whether it's real or nominal. But again, it's important to know the difference between nominal versus real here. Nominal GDP is the total value of all final goods and services produced in the economy using the current year's prices. So whatever year you're in, use that year's prices. Real GDP, it's not going to work that simply here. Real GDP, it's the total value of all final goods and services produced in the economy using the base year's prices. So there's nothing magic about that base year. Usually it's going to be like 2010 or 2000. Usually the base year is going to be, kind of like every decade. It doesn't have to be. You could use 2015 as the base year. But that's basically what real GDP is. Use the constant year's prices as opposed to nominal, which is use the current year's prices. Now, what's the difference here? Well, real GDP accounts for inflation, whereas nominal GDP does not. So, whereas real GDP, because you're using the base year prices, you're not adding to the value of the goods and services. You're not putting the price increases in there. You're using the same year's prices. Whereas nominal GDP, you can't distinguish between a true price increase versus a true growth for the economy, right? So you can't capture the difference because you're multiplying the price times the quantity here. So, fairly easy question here. Which measure is a more accurate means of measuring economic growth? So is it real or is it nominal? Well, easy way to remember it is, if your friends aren't really being completely forthright with you, you say you keep it real. You have to keep it real here. So real GDP is a more accurate means of measuring the economy than the nominal GDP. So real GDP is a more accurate measure of economic growth than is nominal GDP. Okay, so one thing is when you see GDP numbers that are reported out in the media, chances are these are real GDP numbers because they're the ones that actually track what the true growth in the economy is going to be. Okay, so let's take a look at a real GDP example. A real GDP example versus a nominal GDP example. So nominal GDP, let's go ahead and calculate this to make sure you understand how to get the nominal GDP, and then we'll go ahead and find the real GDP. Okay, so how do you find the real nominal GDP? Okay, so nominal GDP, so in 2010, you're going to take 100 hot dogs times 3, and then you're going to add 50 times 1. And that's going to equal $350 here. So That's nominal GDP. Now, what did I do? All I did was I multiplied right here, and then I added the what you multiply 50 times 1 here. Now, this is a very simple 2-item economy where all you have are hot dogs and these are garlic fries. So that's all you have in the economy. So you add that up, you get 300 plus 50 equals 350. That's a nominal GDP in 2010. Now, what's a nominal in 2011? Well, it's 1,000. It's again 100 times 3. So you have 100 times 3 yet again, and then you add 100 times 1, so it's 300 plus 100 equals 400. So you have that as well. Now in 2012, what happens? So it's 150, but notice the price also increased here. So you're going to get, if you use this data, you're going to make it, it's going to seem like the economy grew rapidly when in fact the price of the hot dog actually just went up here. Plus 100 times 2. Same thing, the price of fries just doubled. I'd be outraged if I were a fan. 600 plus 200 equals 800. It looks like, wow, the economy grew, twice the amount. But again, what you saw is you captured a price increase there. Okay, another example here in 2013. Let's see, 200 times 4, so which is what you have right here. Again, plus, let's add a plus right here. Plus 100 times 3. And again, this is 800 plus 300. Now you have 1,100. So you're thinking, wow, the economy's growing, but what you see here is there's no growth in fries. All that happened was fries just cost a little bit more. And there was growth in hot dogs, but guess what? It was only by 50 here. And 2014 is where you see where nominal GDP isn't going to really truly measure economic growth here. So the growth of hot dogs stayed the same, 200 times 5. Just price went up here. And there was no growth at all for fries as well, 100 times 4, but the price went up. So it's 200 times 5, 1,000 plus 400, 1,400. So there's a $300 increase in the nominal GDP, but none of it was true economic growth. So whereas nominal GDP makes it seem like there's growth, if you use the real GDP, then you keep the base year constant here. Now, what is the base year in this case? We're going to use 2010. So let's find the real GDP here. So what we did is we found the nominal GDP. Again, nothing wrong with this data, but again, it's very limited in what it can show. Real GDP. Okay, you want to find the true price increase here. So what happened here? So let's go over the same years. Now, one thing that is a good source of reminder, the real GDP is going to be the same as the nominal GDP in the base year. What that means is that, well, you choose 2010 as the base year price. So let's go ahead and find the real GDP in 2010. 1,000 times 3 plus 50 times 1. It's going to be $350. Okay, so you have the same 100 times 3 here equals 300 plus, which is 50 times 1, which equals 50. So 300 plus 50 equals 350. All right, so what if you still aren't able to figure this out here? So try to guess what I'm going to do, and then again, if you want to try to pause it and try it yourself. Pause this video, try it yourself, and then try to figure out if you did this correctly. So go ahead and pause, and go ahead and try to figure out how to find the real GDP before I go over it. Because once I do the first one, second one's pretty easy here. So let's go ahead and take a look here. So in 2011, so it's 100 here, but guess what? The price here using the $3 mark here. So it's the same here. You get 300. Okay, plus, and then use the 100 right here. But instead of using this price here, use this new price here. So you use that $1 price. Well, guess what? The nominal GDP and the real GDP in this case are exactly the same here, because it's 300 plus 100 equals 400. The reason why the nominal and real are the same is that the price of the fries and the hot dogs, they stayed the same here. So the real GDP is actually the same as the nominal because the price hasn't changed. So if the price never changed, there'd really be no need for real or nominal. They'd all be the same here. But notice how the price of the hot dog here has increased and the price of the fries has increased here. So now you're dealing with 150. Now you multiply by that $3, not that $4. So it's now 150 times 3 equals 450. And then plus 100, again, times that $1. Okay, now you're going to see a little bit of a difference here. Now, the real GDP in 2012 is $500. Notice the discrepancy here. If you use the nominal, then you track the doubling of the price of fries and the increase in the price of hot dog here. But you keep it real. Now it's only $500, right? Now, in 2013, now you're taking that 200 and you multiply by $3, so you get 600 here. And then you multiply 100 times that 1. So there's no growth in French fries here. And you get 100. And so now it's 700, not $1,100. So again, there's more kind of inflation that's tracked in nominal GDP. And then finally, in 2014, 200 times 3 equals 600 plus 100 times 1. So notice everything was stagnant. If you take a look at the nominal GDP, then it looks like there was this huge growth in French fries, but in fact, there was really no growth after that first year. And so the real GDP is 600. There's no growth in hot dogs that year, is also 700. So basically, the economy doubled from 2010 to 2014. Not bad, but if you take the nominal GDP, it'll look like it quadrupled, and which it clearly didn't. So nominal versus real. This is a brief way of being able to calculate how to find nominal versus real. And this actually did appear on a recent FRQ exam. So make sure you do know how to calculate. Not only do you know the definition of nominal GDP and real GDP, but actually how you calculate it. And again, they're not going to give you a complex, even like a 15-item economy. It'll be simple, maybe just one item, but probably 2 different items to be able to calculate. Can you accurately figure out what nominal GDP is and real GDP, and can you differentiate what they actually mean? So real GDP per capita, we'll go ahead and take a look at this here. There's not going to be a whole lot of examples I'm going to use. I think once you understand what this actual measure is, what the purpose is, then I think that generally is enough as far as what you want to know for the AP exam. So real GDP per capita. So what country has a better standard of living, China or Taiwan? Again, according to China, Taiwan actually is part of China, but I'm not going to get into the politics of that. Let's assume that China and Taiwan, you're trying to figure out which one has a better standard of living. Well, in terms of both nominal and real GDP, there's no question. China has higher figures. Clearly, China is a very large country. You're not going to have too much debate. So if you want to be in a country that has a large GDP, then go to China. However, that's not what we're looking for. We don't want to really care about real GDP or nominal GDP for that matter. We want to see real GDP per capita. So another way of saying per capita is per person. So we want to take the GDP divided by the size of the population, which is equivalent to the average GDP per person. So what do you get? Very simple look at that. Again, I don't have specific figures, but it's quite obvious. In Taiwan, the GDP per capita is significantly higher than that of China. So let me throw out some hypothetical numbers. In Taiwan, it might be closer to $40,000 to $50,000 per person, whereas in China, you're getting maybe $10,000 per person. So the standard of living in Taiwan, if that's important to you, if you want to have a higher standard of living, there's a lot more income equality, where there's more of a middle class, so to speak. In China, you see more of a divide between the rural poor and the urban rich. But GDP per capita is a good measure of what's the standard of living in the country. So, I mean, if your goal is to live in a country that has a higher standard of living, then GDP per capita is probably the best measure. So, yes, it is an imperfect measure, but generally it's the best measure for standard of living. So, again, it's something that you do want to take into consideration. So you have real GDP, you have nominal GDP, you have GNP, you have GDP per capita. So there's all these different measures, and again, for standard of living, you want to use real GDP per capita. Thank you for watching Educator.com.